Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are going on a deep dive into three really critical forces that are kind of reshaping the global economic rulebook. We're going to look at how governments use just their voice to manage currency.
A subtle but powerful tool.
Exactly. Then we're moving to something massive, a big shift in supply chain strategy in the Middle East. And finally, we'll touch on the surprising resilience of China's domestic AI chip market.
And these three things, they might seem disconnected, but they really aren't.
Yeah.
Our goal today is to cut through all the noise. We want to get into the mechanics, the why behind all this.
Right.
So when you're done with this, you won't just know that the Korean won moved. You'll understand the specific policies and, the paradoxes that make these events matter for the whole global economy.
Okay, let's jump right in. Let's start with that currency intervention. So data shows the Korean won, the KRW, it saw this really sharp short-term jump, about 1.7% against the dollar in mid-December. And normally you see that and you think, okay, big interest rate hike, or maybe a huge change in trade policy.
According to the research, that wasn't it at all. This wasn't driven by, fundamental economics. This was pure policy communication. The Korean authorities, they essentially just talked tough.
They just talked. They didn't have to spend billions buying up their own currency.
Not yet, anyway. They issued these very strong verbal warnings, repeatedly stating that an overly weak won is undesirable. And they used this very specific phrasing about making the market feel their great determination.
It's like a preemptive strike with words.
Exactly. And I love the analogy that some analysis uses here. It's like a speed trap on a highway.
Okay, explain that.
Well, the government wasn't so worried about the car's final destination, the actual long-term level of the currency.
Right, they weren't saying it has to be exactly 1,300 won per dollar.
Precisely. They were worried about the speed, how fast the car was going in the wrong direction. The data shows they focused on the momentum, a concept they call days.
Slim. And why does that speed matter so much? A with one helps exports, right?
It does, to a point. But a currency that weakens too quickly creates panic. It creates instability. You risk scaring off foreign investors and seeing a huge outflow of capital.
So people see it dropping fast and think, I got to get my money out, which just makes it drop even faster.
You've got it. So the verbal warning acts as this really effective, low-cost way to make speculators think twice. They hear the warning, and they know the central bank is serious about stepping in for real.
So they back off.
They reverse their positions quickly. But that's just the short-term fix for the panic. There's also this longer-term structural issue.
You're talking about all the local investors buying U.S. stocks.
Yes, the so-called CEO-hack-gamey, or Western ant investors. They create this constant low-level demand for U.S. dollars as they buy up tech stocks. It's a structural drag on the won.
So the speed trap handles the daily panic, but what about that steady drain?
Well, for that, the government is using other tools. The analysis points to things like tax incentives designed to steer some of that money back into domestic markets instead of overseas.
So it's a two-pronged approach.
A very sophisticated one. The key takeaway for any global investor here is that the Korean won, it's a floating currency, sure, but it is not abandoned. There's a definite speed limit.
The faster it falls, the more likely the government is to step in.
You have to watch that reaction function. It's a game of managed expectations.
Okay, let's transition from managing money flow to managing, the flow of actual stuff. This is where geopolitics gets really interesting.
It really does.
Recent analysis shows China has secured over $1 billion in investment contracts with Egypt, specifically in the Suez Canal economic zone. We're talking factories, polyester, tires, that kind of thing.
And the key here is the location. This isn't just about building factories somewhere cheap. This is right on the doorstep of one of the most critical maritime choke points in the entire world.
So what's the real strategy? Is this some kind of military play to control the canal?
The data suggests no. It's a long-term economic play. Think 10 to 20 years out. The idea isn't to control the shipping lane itself.
Oh, yeah.
It's to control the logistics and manufacturing hubs around the lane. It's like you don't need to own the highway if you own all the warehouses and on-ramps.
So controlling the warehouse, not the highway. I like that. They can make stuff right there and slash shipping times to Europe and Africa.
Exactly. They are turning that zone into a strategic crossroads, an extension of their own manufacturing base.
Which brings up the obvious question, and the analysis gets right into it. Why isn't the U.S. blocking this? I mean, the Suez Canal is incredibly important strategically.
It is, but it comes down to that distinction between military and economic power. The data is clear. The U.S. is hypersensitive about military control, about freedom of navigation through the canal.
But this isn't that.
This is China investing in an economic zone. It's foreign direct investment, FDI, under Egyptian sovereignty. It's a very sophisticated gray zone strategy.
It's technically legal and above board, but strategically, it's a huge move.
And that makes it very hard for Washington to publicly oppose. I mean, how do you tell Egypt, a key ally, that they can't accept investment that creates thousands of jobs?
You can't, not without causing a major diplomatic incident.
So the U.S. has to play a longer, more indirect game focusing on supply chain diversification with other allies, maintaining its security role.
And from Egypt's side of things, the analysis makes it sound like they don't have much of a choice.
For Egypt, this is about economic survival. They're facing foreign currency shortages, high unemployment. They need capital, they need jobs. Geopolitics is a luxury they can't afford right now. They're taking the capital that's on the table.
So the battleground is shifting. It's not just about who has the biggest navy anymore.
It's about who owns the industrial infrastructure around the choke points. That's the real insight here. You have to start looking at the Suez economic zone as a long-term logistics hub that's being integrated into a whole new supply chain structure.
A fundamental shift. Okay, let's pivot one more time to technology, to AI chips, and the very counterintuitive effects of regulation.
Yes, this one is fascinating.
So analysis shows that SMIC, which is China's biggest chip foundry, just announced a 10% price hike on some of its key products. And its stock jumped. That's a huge signal of pricing power.
It's a massive signal. Because historically, Chinese foundries have really struggled with that. The data shows the immediate cause is just this explosive growth in China's domestic AI sector.
Not from a government order, but from actual commercial demand.
Exactly. Driven by the rise of really powerful open source models like DeepSeek, the market is just taking off.
But wait, I thought U.S. sanctions were supposed to be kneecapping their ability to make high-end chips. So how are they driving up prices?
That's where you have to get into the weeds a little bit. The distinction is crucial. This huge demand isn't for the absolute cutting-edge chips used for training the next massive AI model.
Okay, can you just clarify that for everyone? The difference between training and inference.
Sure. Think of it this way. Training an AI is like building the brain. It's incredibly complex and requires a supercomputer with the absolute best chip, say a 3-nanometer chip. That's where U.S. regulations are really biting.
Got it. Building the brain.
But inference is the process of using that brain for a specific task, running an app, generating an image. It still needs a sophisticated chip, but a slightly older 7-nanometer class chip works perfectly fine.
And SMIC can make those 7-nanometer chips without the advanced tech that's been restricted.
Exactly. And they're basically the only domestic game in town for that. So they are completely overbooked. You have giants like Huawei planning to double or triple their AI chip production. That capacity crunch gives SMIC a near monopoly position at home.
Which brings us to the biggest question in all of this, which the research tackles head-on. Does this mean the U.S. regulation strategy failed?
The analysis says no, not a failure, but a mismatch between what was intended and what actually happened.
A paradox.
A total paradox. The U.S. goal was to stop China from reaching the absolute cutting edge of AI training, those 3 to 5 nanometer chips. And for now, that goal is mostly intact.
So the U.S. capped the ceiling.
They capped the ceiling, but they unintentionally supercharged the foundation. The regulation forced China to switch its whole strategy. They basically abandoned the race to the top for now and instead focused all their resources on building a massive, efficient, good enough domestic ecosystem.
And that acceleration is a direct result of the regulations themselves.
A direct result. It's fundamentally changed the nature of the competition, and it suggests the global AI chip market is splitting in two.
A bipolar market.
That's what the data points to. You've got the U.S. and its allies focused on ultra-high-performance training GPUs. Then you have China focused on mass volume inference and deployment, using their own domestically designed and produced chips. Two parallel ecosystems.
So the real insight for investors is that SMIC's price hike isn't a sign they've closed the technology gap with, say, TSMC.
Not at all. It's a sign that U.S. regulations have created a protected, powerful domestic monopoly inside China. The question isn't who has the best chip anymore. It's becoming who is actually running the most AI applications.
Wow. That was a huge amount to cover. Let's quickly recap the 3 big lessons here. First, with currencies, governments are managing the speed of change, not just the level.
Right, using those verbal warnings as a kind of speed limit. Second, we saw that geopolitical competition is shifting from military control of the highway to economic control of the industrial zones around it.
And finally, that tech regulation didn't stop China's AI growth. It just radically changed its form from a focus on the absolute peak to a focus on massive domestic volume.
And if you put all three together, you see a theme emerge. Global stability seems to be more and more about managed volatility. It's less about absolute control and more about setting predictable limits. The Korean one has a speed limit, Suez has an FDI limit, the Chinese AI market has a nanometer limit.
So the final question for everyone listening to think about is,
What boundary or what speed limit do you think is going to be tested next?
don't forget to subscribe and hit that like button.